Well, welcome everybody to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is my partner Cameron Mealy, and today we will review what happened last month from a market standpoint, economic standpoint, and with our major portfolios here at the firm, and kind of give you an idea of what we think is going to happen over the next month or so, and how we're positioning portfolios accordingly. Cam, why don't you kick us off with the economic update?
Great, thank you, Kelly. Good afternoon, everybody. A lot of big news last week. So on Friday, the Bureau of Labor Statistics announced the March employment reports, and non-farm payrolls rose by 916,000 in March. The unemployment rate dropped to 6%. That was a bang-up jobs number. The Dow Jones estimate for new non-farm payroll jobs in March was 675,000. So basically had almost 250,000 additional jobs on top. Where the jobs come from? This is great news too. Jobs are mostly in construction, manufacturing, warehousing, logistics, retail, and professional services. So good quality jobs. Not seasonal, not leisure and hospitality, which you would have expected, but good kind of base quality earning jobs. Great jobs number. That was buoyed also by the Institute for Supply Management. Came out with what they call their ISM report, or really a measure of the manufacturing industry. So manufacturing expanded in March at the fastest pace since December 1983, according to their survey, which came out on Thursday. As you remember, in February, we said that manufacturing had expanded by the highest pace in almost 20 years. So the manufacturing sector is hot. A lot of pent-up consumer demand, a lot of government spending. We've been over these issues. Biggest thing, really, though, that came out of the ISM report on Thursday was where the constraints are. So I'm going to read this. This is from the Institute for Supply Management. The manufacturing economy continued its recovery in March. However, survey committee members reported that their companies and suppliers continue to struggle to meet increasing rates of demand due to COVID-19, impacts limiting availability of parts and materials, extended lead times, wide-scale shortages of critical basic materials, rising commodity prices, and difficulties in transporting products are all affecting segments of the manufacturing economy. Worker absenteeism, short-term shutdowns due in part to labor shortages, difficult in filling positions continues to be an issue.
Those first 2 points, one on the unemployment and then what's going on in manufacturing. In talking to some of our business owner clients who are in the manufacturing world, the reality is, yes, there are supply constraint issues, but most of the owners or executives, they feel, hey, but business is still good. It's not going to tank their businesses. This happening early in an economic cycle, coming out of recovery from COVID, companies are going to deal with it well. And that's been translating back to the stock market. On the job standpoint, obviously we have large stimulus bills coming through the pipeline. I have to make the comment, the projection is the stimulus bill is going to create 2.5 million jobs. I would argue that $2.5 million jobs are going to be created regardless, just because of the reopening, and that's kind of what's happening now. Is the economy is definitely improving, and all the stimulus is throwing fuel on the fire. So we're in for some good economic times, at least in the short term, the next 12, 18, 24 months.
Yeah, I was going to say red hot is the way to describe this economy. So something we often quote is the Atlanta Fed's GDP Now model. It's the recognized great predictor of GDP. On April 1st, the GDP model for the first quarter was 6% growth. So that's an annual 6% growth rate. Based on the jobs numbers, based on the ISM report, I wouldn't be surprised. Today is the day they typically update the report, the model, I wouldn't be surprised if it came in at 7-8%.
I've heard numbers as high as 10.
Yeah, I can believe it.
Things are starting to roll.
The economy is, as I said, red hot right now. There is just a ton of stimulus out there that's really riding this economic train. And if you look at last week, what we also heard was that President Biden has proposed a $2.3 trillion infrastructure plan. It's tough to call it an infrastructure plan because only about $600 billion or 25% is dedicated to infrastructure, roads, bridges, water, fresh water, wastewater, broadband.
Depends on your definition of infrastructure, Cam.
There is, all I'm saying is there is just, I think we've seen it with let's face it, with both parties, whether it was President Trump, whether it's President Biden, whether it's Republicans, Democrats, I think everybody thinks the key right now to sustained power in Washington is spending. So if President Biden's $2.3 trillion infrastructure plan does go through, we'll have a couple $1 trillion spent by President Trump in coronavirus relief, a couple trillion spent by President Biden. Now you throw another $2.3 trillion on that. It's over $6 trillion of basically the government printing money that we've seen over the last 2 years. And I know we talked a while ago about the Great Reset, but the U.S. certainly has a debt problem. If you look at U.S. debt today, we're at $28 trillion of total debt. That's $85,000 per citizen. I know we're not facing a debt crisis today and probably won't be for many decades, but eventually austerity, tax increases, the limited ability of government to spend, something has to come to a head.
Well, part of it is, yes, when you look in absolute terms just in the U.S., but once you put it in the context of the rest of the world, everybody's kind of in the same boat. So that changes the whole dynamic of it. And, we're definitely going into a new economic era that there are no models for. Obviously, the core principles, core economic models still hold true. But, where this goes to, I don't see it being, hey, everything is going to, collapse and it's just everything's going to be different. And the reality is we just need to be conscious of the changes. And we can't invest for what should be. We invest for what is. And that's the challenge now is, hey, we want to be where the direction we're going in, participate in those areas that we know should work, but not be too speculative about it. We're not going to speculate on the future, but rather, hey, we're going to invest on the way things are. And once again, it all comes down to if you run a small business, or if you're running a good quality business, you're going to do well no matter the environment. You'll have your ups and downs; they won't be extreme. But you just to speculate on what could come. Yeah, you're always somewhat looking at what could come, but you have to look at the realities of today. And if you run a good, solid business, or we find a good, solid business that we invest in, those are the companies we're looking at.
And this is obviously, this is more of the debt thing is more of a philosophical discussion. We could do a whole video about it. But right now, America's getting back to work.
That's the reality.
Pumping in fresh cash. Inflation with all this cash and with the tight labor market and supply shortages is obviously a concern. But right now, things really do look good for the foreseeable, at least for the foreseeable investment horizon.
I agree. Inflation's the big wild card. Nobody knows, everything says we should be seeing inflation with all this excess fiscal stimulus coming in. How it manifests itself, nobody really knows. And, that is ultimately how stimulus gets paid for. Historically, that's always the way it's been. Taxes will go up here and there, and that's a reality too. Is a lot of people are concerned about potential tax increases next year, which very well could cause even more economic activity in 2021. Absolutely. In anticipation of 2022 taxes going up. I was just talking to a gentleman that runs a private equity firm, and they're trying to get as many deals, as many buys and sells done this year before taxes go up. So you're going to see a heightened activity in mergers and acquisitions. I think it's going to be a crazy year.
Yeah, people will definitely be taking chips off the table too.
Yep.
They're going to be selling winners towards the end of the year.
Exactly.
So,
anything else?
No.
Any other major economic headlines or updates?
No. It's
from a portfolio standpoint, so far so good this year. Year to date, the Dow is up 7.76%. Year to date, the S&P is up 5.8%. NASDAQ's lagging. So when we put that into context, you can see, kind of the hot stocks that really were strong last year that are in the NASDAQ, which kind of drive the NASDAQ, and a good portion of the S&P are starting to lag the more cyclical-oriented, economically sensitive stocks of the Dow Jones. So we saw that shift start back in third or fourth quarter last year, and it's continuing. That doesn't mean tech stocks are going to tank, but we're starting to see them lag a little bit. In small caps, Russell 2000 up 12.44%. Obviously, small caps are really strong last year. They've given some back this year, but still up nice. On the international front, the Developed World Index, the EAFE, only up 2.8%. Emerging markets only up 1.95. Emerging markets have definitely been a little bit weaker this year. They were fairly hot last year. In March, the Dow picked up 6.6% of that 7.6% last month. S&P, pretty good month there, 4.24%. NASDAQ was only up 0.4%. You can see the Russell 2000, once again, you saw some cooling off in more speculative stocks, more stocks that are really geared around future potential returns. The Russell was only up 0.88%. Growth with income, our balanced portfolio, year to date 1.26%. In March, we were up 1.56. A couple of struggles there. We have a gold position, which was down, down 10% year to date. And I'm sorry, where was our other weakness came in Apple and NVIDIA. Year to date, our big gainers, Lennar, we had bought late last year, up 33%. Cisco, kind of getting a nice bounce, up 16.5%. Microchip Technology, up 12.66% year to date. Berkshire Hathaway, a good solid holding of ours, year to date up 10.6%. Probably, our biggest loser, like I said, gold down 10%, Apple down 7.8%, Nike down 5.87%. So that's kind of how we stand in growth with income. In our dividend yield portfolio, kind of showing a lot of strength this year, up 8.44%. For year to date. In March, 8.33%. So last month it was barely into the positive. Now definitely picked up some speed in dividend yield. Intel up 29.2%. Caterpillar up strong 28%. Prudential seen some life in the insurance companies, up 18.3% year to date. Blackstone up 16.5%. Year to date, Merck taking some, kind of pulling back a little bit, down 4.94%. We actually traded out of that. I think a couple weeks ago, and then Coca-Cola down 3.08% year to date. So a little bit of shift in what's going on there, but a good first quarter for dividend yield. Price potential, year to date, we're at 4.25%. We had been lagging in there. In March, we're now up 3.75%. So price potential is starting to pick up some steam. General Dynamics year to date, we're up 22.87. Aflac, another insurance company, up 15.94. Anthem, another insurance company, up 12.7%. And then Amgen up 9.03%. Kind of our big losers in price potential year to date. Perking Elmer, they're kind of a medical, they're around diagnostic company. They're down 10.56. Once again, they were strong last year. As the COVID news starts to die down a little bit, we're starting to see some of these pull back. Edwards Life Science, same thing, down 8.32%. PepsiCo started the year off weak, we're down 3.86. So, but in general, price potential's, really starting to pick up some steam, and I like the positioning in price potential a lot moving forward. I think that we're going to see good growth in there. Small caps year to date, up 11%, but March, once again, we saw some pain in there, down 1.25 for March. Still have some big gainers year to date. Fulgent up 85%, Atcor up 75%, Overstock up 38%, LG Homes, once again, the home builder theme, up 41% year to date. Where we see the weakness, Novacure, which we made, I think, overall we're probably up a couple 100% in there, but that gave back about 23% last month. Kodiak Sciences down 22%. Same thing, Kodiak, I think, so we're still up over 100% in there. And then Q2 Holdings down 21%. So in general, we're seeing good things happen across the board. You're definitely seeing a rotation inside the market. I like where we're at because the bulk of our dollars are in the areas where the rotation's going to. Some of our legacy big gainers, Apple, NVIDIA, probably going to be a little bit challenged. Even Nike, a little bit challenged. They were strong gainers. We're not really looking to move away from them, but we know they could be a little bit of a drag on the portfolio moving forward.
They're still great companies. They're still great companies. They're companies we want to own, but they've run very far and very fast.
They
for a
drove
long
us
time.
last year. They're gonna, sit on the bench for a little while, I think.
Yep.
Other than that, I think our commodity position, obviously Cam talked about commodities, inflation fears. I think commodities are going to definitely help us. Gold's had, a bit of a challenge this year, but I think we're finding a base in there. I think the metals are still going to play out for us. Moving forward this month, we have the stimulus behind us. In general, I think a lot of tailwinds. Obviously, we have to be, conscious of volatility. We know there's going to be some volatility, but for at least the next, several months, I think we have, good wind behind us, and, we're going to, I think, see some gains ahead of us for a while.
Mm-hmm. And lastly, as a reminder, our primary mission at Ellsworth Advisors is your wealth manager. We want to be your wealth manager in terms of the context of your lifestyle. We try to maintain regular and active communication with all of our clients, but please, as always, if you have a change in lifestyle, you want to buy a second house, there's a sickness in the family, unfortunately, you decide to put a down payment on a house for your kids or grandkids, or you want to fund a 529 plan, would any of these changes come about in your life, please let us know. Let's sit down, let's relook at the plan. The wealth plan is only as good as the context of a lifestyle plan. And so, continue to think of us as an advisor for all financial issues. We're here, and, we want to know what's going on so that we can react accordingly. And hope you have a great month. Happy spring, and we'll talk to you next month.
Thank you. Have a great month.